From the trading desk of dailyforex.com, this is Christopher Lewis looking at the dollar yen pair for the upcoming May 1st Forex session. As you can see, I have the daily chart pulled out in front of you, and a little bit of review what we've seen recently in the dollar yen pair. We have, and I'll just draw it instead of going back, but on the weekly chart, there was a trend line going back to the financial crisis that was broke right around there. And what caught my attention was we did break out, form a hammer, and then continue to climb. It is from this bottom that I've drawn a Fibonacci retracement tool, and you can see that the 80 comes into play. We also have the 50% Fibonacci level right above it, and of course you can see that I have the 200-day EMA here, and as such we had a lot of confluence going into the Monday session. You can see that 80 didn't really hold. Of course, it hasn't really given way either. I mean, we are just about 17 pips below that right now. You can see I'm recording this at the very break of the Tuesday session. And as such, we find ourselves at a little bit of a crossroad in this pair. I mean, there are a lot of people who are selling this, and there's different reasons why they may be doing this. There's a belief that perhaps the Federal Reserve Chairman Ben Bernanke last week on Wednesday suggested that the Federal Bank or Federal Reserve could ease if it was warranted, and would going forward if the economy warranted it. But the question really remains: does that mean that they are going to ease? And the reality is he didn't really say one way or the other. And I think a lot of the traders out there are going to be caught on the wrong foot if just the right words are said, essentially. A lot of people have taken to heart that that means that QE3 is coming, but quite frankly, if the employment picture in the United States stays, robust is probably a strong word, but if it stays a little bit lively like it has, the bar has to be pretty high for QE3. This is a political year. This is an election year, and there are a lot of people in the United States that are very upset about all of this quantitative easing. So although the Fed's supposed to be an independent body, let's not kid ourselves. It's a very political body. And as such, the bar may be kind of high. Of course, Bernanke's not going to let the economy slip into some kind of massive recession either. And if that means printing money, then that means printing money. Having said all of that, the Bank of Japan on Friday also announced that they were expanding their quantitative easing by 10 trillion yen, which is no small amount. They are purchasing JGBs, the Japanese government bonds, which they've been doing for a very long time. Now REITs and ETFs are thrown in the mix. They have bought ETFs in the past from time to time as well. So not necessarily new, but the fact that they're expanding does suggest that they are ready to get serious about killing off the yen. Quite frankly, that economy needs a weak yen. The demand domestically just isn't enough for the economy to keep going, and Japan has major problems from a demographic side as well. So the action on Monday saw the pair fall directly to the 200-day moving average, or saw a bit of a bounce. So at this point, we have to ask ourselves some questions. Is this going to continue lower? Well, in that scenario, I have no interest in selling this, quite simply because the Bank of Japan is going to lose its sense of humor about this soon if this continues. They have to be just absolutely mortified that somewhere one of these two bars, I think it's this one, they had suggested the 10 trillion yen expansion, and you can see what we've done since then. It's just gone against them. They do intervene. They may very well do it relatively soon if they break down too far. Certainly the bank is going to lose its sense of humor. If the Fed disappoints and doesn't ease, quite frankly, I would suspect, at least at this point, that they don't really have any plans to do so, this market will snap back in a heartbeat because it is completely out of balance. Having said all that, I am watching this area right now for some type of sell or buy signal, perhaps a hammer or a reverse or something to that effect. If we fall lower, I'm just simply not willing to sell. I do not want to argue with the Bank of Japan. So this is kind of a binary trade for me. Either I get the supportive candle I'm looking for and buy, or I'll just let this market go and wait till we fall much farther and see if there's some type of supportive action back then, or if the Bank of Japan starts to expand programs, et cetera, et cetera. But the fact is that we did break out, and unless this was probably the world's most brutal false breakout that one can imagine, there has to be some kind of substance to it as well. So we'll see. But the next 24 to 48 hours should be very interesting. Also of note is non-farm payroll. If that comes out stronger than expected on Friday, this pair will just check out, as that will certainly put a lot of doubt into the idea of easing and should strengthen the dollar against the yen.